the Federal Reserve Bank's inflation fight just got a little bit tougher. Remember, the Federal Reserve Bank has been working to raise interest rates to do one thing: cool down inflation. But we just got some new data saying that this inflation fight isn't going the way that the Federal Reserve Bank anticipated. And this is why now the Federal Reserve Bank is having to face this tougher dilemma of, do you have to wait even longer than expected to start cutting interest rates, even though you have a lot of people in the United States, including the White House, hoping that the Federal Reserve Bank will cut interest rates sooner than expected. So there are three main factors that the Federal Reserve Bank is looking at when they are making this interest rate decision. First, they're looking at consumer inflation. Second, they're looking at producer inflation. And third, they're looking at the economy. Let me start by talking about consumer inflation, because consumer inflation is the inflation that you and I face. Regular people face when you have to go out and buy things like groceries or buy a home or rent a home or go on a vacation. That's consumer inflation. Producer inflation is the inflation that business owners feel when you have to go out and buy raw materials or get services or goods in order to produce products that you sell to customers. And the third thing that the Federal Reserve Bank looks at is the economic growth. How strong is the economy growing? What is the job market looking like? And all three of these things in the last 10 days have come out much hotter than expected. Let me start by talking about consumer inflation, otherwise known as CPI. And the most recent data that we got on Valentine's Day in 2024 is that consumer inflation is moving hotter than expected. Let me just read you directly from CNBC. What it said is that core inflation came in at 3.9%, which is higher than the 3.7% expected inflation, and that's clearly higher than the 2% inflation that the Federal Reserve Bank is aiming for. Remember, the Federal Reserve Bank does not want 0% inflation, they want 2% inflation, and core inflation is the inflation measure that the Federal Reserve Bank likes to look at, and this core inflation came in at 3.9%, almost double what the Federal Reserve Bank is aiming for, and the 3.9% inflation that we actually saw is higher than what was expected at the 3.7%. So that's the consumer inflation that came in hotter than expected. Then we got the producer inflation numbers a little bit after Valentine's Day. And the producer inflation numbers also came in hotter than expected. Let me read you another quote directly from CNBC. And by the way, I will link these articles for you down in the description in case you want to dig into this yourself. What it said is that core PPI, Producer Price Index, excluding food, energy, and trade, jumped 0.6%, which is the biggest one-month advance since January 2023. So the producer price inflation also came out hotter than expected, and it was one of the hottest months of inflation in about a year. And then we have number three, which is the economic data, which is what the Federal Reserve Bank looks like. Because what the Federal Reserve Bank does is they use this interest rate tool that they have as a way to balance inflation and the economy. So we just got the news that inflation is hotter than expected. Inflation for consumers, inflation for businesses is hotter than expected. But then they have to balance that against the economy, because higher interest rates generally cool down the economy. In fact, they are supposed to cool down the economy, because when you as a business have to pay more money to borrow money, then you're naturally going to borrow less money. And this is what the Federal Reserve Bank uses as a tool to cool down the economy. Well, the higher interest rates haven't really had that impact yet, because right after this data, we got the latest economic data about our job market here in the United States. And what it said is that in the month of January, it was expected that our economy would add around 185,000 jobs. Well, in actuality, our United States economy added 353,000 jobs. So jobs are growing faster than what the Federal Reserve Bank is expecting. Now, while this might sound like good news, this was actually bad news for the Federal Reserve Bank. And this is something we've been covering in Market Briefs, which I'm going to go over now. But Market Briefs, for those of you who don't know, is my free financial newsletter that my team at Briefs Media creates every day. It's a way for you to stay up to date on what's happening in things like the economy, the housing market, the stock market, the crypto market, and the global economy into a fun, witty, and easy to read newsletter. You can read Market Briefs in less than 5 minutes every morning, and it's completely free. So if you have not joined Market Briefs yet, I got the link to how you can join down in the description below, or you can go to briefs.co/market. That's briefs.co/market. Now, let me start talking about why the Federal Reserve Bank has this as bad news when you see jobs number come out hotter than expected. And this really just ties back into the inflation metric that the Federal Reserve Bank is measuring. Because if everybody has a job, what does that mean? That means everybody has an income. What does that mean? That means everybody has the ability to spend money. What does that mean? That means everybody has the ability to go into debt and spend even more money. What does that mean? Strong economy and more demand for products. Now, generally, in a normal economy, this is great news. That's exactly what you want. You want people going out to get jobs. You want people to go out and get pay raises. You want people to go out and qualify for credit. That way they can go out and spend money in the economic system. Now, I'm not saying it's your duty to go into debt to support the American economy, but I'm saying that's how the economic system works. And so now when you have an economy where inflation is already a problem, and then more and more people are getting jobs, more and more people have that ability to keep generating that income, that's bad news for the Federal Reserve Bank. This is why they keep coming out and saying that they want to soften the labor market. Softening the labor market is the politically correct way of saying they want people to lose their jobs. They want higher unemployment. Now, they don't want to go out and say that because that's going to create a lot of controversy, but they've come out and said it in many ways indirectly. They've said they want to soften the labor market. They've said that they expect unemployment to rise as a byproduct of higher interest rates. And so now we are in this economy where the Federal Reserve Bank has been working to raise interest rates in order to cool down inflation. And the byproduct of cooling down inflation is higher unemployment. The problem is, inflation isn't coming down to the 2% number as fast as the Federal Reserve Bank would like. And the byproduct, which is the cooling economy and the higher unemployment, well, that hasn't really happened yet here in the United States. Now, there's a lot of people that are expecting and anticipating that we will eventually see this cool down in the economy, maybe towards the second half of 2024, but we haven't seen it yet. And the reason why we haven't seen it yet is because the American consumer is resilient. And this is what traditional media outlets like to call people are spending money like crazy. People are spending money they don't have. We have seen credit card debt break an all new record high just recently. We're seeing people use buy now, pay later all the time. It has become so common for Americans to be broke and in debt and for that to be normal. But see, that's the problem. It's a problem on the consumer side because if you're broke and in debt, then you never have the ability to build wealth for yourself. And it's a problem for the economy because if everybody is broke and in debt, eventually you're going to hit a breaking point. And when the breaking point happens, that means people have to cut back on their spending. And when people have to cut back on their spending, that means all these businesses that have been relying on all this debt spending are going to not be able to generate that revenue in the future. And if they can't generate that revenue, that means sales slow. Now, this is a natural byproduct of our economic system. I mean, our economic system moves through cycles. This has happened for decades, for over the last century. But the reason why this is more significant today is because of the amount of debt out there in our economic system today. We have more debt than ever before. Not just households, not just corporations, but also the United States government. We have the most cumulative debt than ever before. And that's the concern here, is if more and more Americans are going deeper into debt to just finance this lifestyle, it's going to hurt their ability to continue spending when things get tough, because eventually things will get tough. That's a part of our economic system. So then when things get tough and they have to pull back, you can start to see why that could create more economic pain in the future. Now, this also creates opportunities for those who are financially educated, for those that are aware of what's happening, for those that are prepared, but for everybody else, that's gonna hurt. And this is where you can start to see that bigger divide between those who understand money, the financially educated, and those who don't. And more people are not financially educated, and they're wondering why they're getting left out of the system. And then we just look at interest rates. The other factor that you want to understand are treasury yields. And what treasury yields are is the interest rate that you can get by lending your money to the United States government. This is known as the risk-free rate because if you lend money to the United States government, which anybody can do, you can do it, I can do it, governments can do it, banks can do it, anybody can do this. If you lend money to the United States, it's almost like a guaranteed return that you're going to generate. And the reason why is because the government has the ability to, number one, tax their citizens to pay their debts. And if they don't have enough money to tax their citizens, the second thing that they can do is they can print this money. So unless the United States government defaults, which of course is possible, but in the grand scheme of things is not very likely today because they are the strongest economy in the world, they're the strongest military presence in the world, they're the strongest central bank in the world. So in terms of the likelihood of it, very low, which is why many people like to call lending money to the government these treasury yields risk-free rates. Well, what we've been seeing happen, especially over the last month, is that these treasury yields have been rising up and up and up slowly over the last month. You can go to Google and just search the 10-year treasury yield to take a look at what I mean. Now, the reason why this matters is because this has an impact on interest rates that you have to pay even if the Federal Reserve Bank doesn't touch interest rates. And the reason why is because now from a bank or lending perspective, when a bank goes out and lends you money, they are making an investment. And that investment is this loan. So now this bank has to weigh their different investment options. They're thinking about, well, what is the risk versus return if we keep this money in our bank account? No risk, no return. Then they say, well, what if we take a little bit of a riskier investment and we lend this money to the United States and government? Low risk and a higher growing return. And then they look at, well, what if we lent this money to you to buy a car or to buy a home? More risky because you don't have a money printer like the government and you don't have the ability to generate taxes like the government. So you are a bigger risk than the United States government is. So naturally, if I'm a lender and I'm going to lend you money versus the government money, I'm going to expect a higher rate of return from you. And so now this is why you have to pay attention to these treasury yields, because as treasury yields have been rising over the last month, interest rates for consumers to buy a home or to buy a car or your credit card debt has also been rising. And this is happening even though the Federal Reserve Bank hasn't raised interest rates in almost a year now. And this is where I want you to understand there are many different factors that influence different parts of the economy. The economy is a very large and intertwined web of different systems. And you want to understand this, that way you can understand how the different pieces of our economic system move together. That way you can be a more financially educated investor instead of being a panicking investor, because no good financial decisions are made out of panic. No good financial decisions are made out of fear. And this is where you want to be educated enough to understand the different pieces that affect our economic system. That way you can find the opportunity and build wealth for yourself, no matter what's happening. But that requires you to understand how our economic system works. Now again, if you want to stay up to date on what's happening, you can join Market Briefs. I got the link for you down in the description below. And with that, I'll see you tomorrow.